I'm Brian. I'm going to show you something that will blow your mind. Conceptually, you'll say, this doesn't make any sense. But mathematically, it does. At least I think it does, because I put it in the calculator a million times. But this is something that no one talks about. Bankers don't talk about it. The mortgage lender doesn't talk about it. You name it, no one talks about it. Now, I'm going to show you something that's going to happen on day 1 or day 2 after you get your mortgage. You could do it later down the road. So don't think that if you're already in a mortgage, this isn't going to help you. I'm going to show you a principle that helps you save quite a bit of money. A lot of people say, well, velocity banking, and this is sort of like velocity banking. I'm going to follow this with another video which shows how you can implement this in a velocity manner using velocity banking to save even more money over time. But let's get down to what this hack is. Actually, first I should say, please smash that like button. It helps get this message out to more people. We want to get people out of debt. That's what my channel's about. And then help them save money for passive income. Because to me, real freedom is financial freedom. If you haven't already, please subscribe. Now, check this out. This is real simple. It's real straightforward, but stay with me. I call this the secret mortgage hack because it's a really cool name. We're going to talk about a mortgage. This is June of 2024 when I'm making this video. So a 30-year mortgage at around 7%. I looked at the median home price across the U.S. and it was about $420,000. I'm trying to use nice round numbers to try to illustrate this. Okay, let's say that you have roughly 10% to put down. It doesn't matter if it's 10, it's 5, it's 20. Just this is conceptually how it works. You've got 10% to put down. 10% of 420,000 is 42,000, but we're just going to use the round number of 40,000. Okay, there's two options here. Option 1, you walk in, you bought your $420,000 home, you put $40,000 down, so you've got a mortgage of $380,000. I've got 3 numbers down here. The payment is $2,528 a month. Now, I'm not getting into, this is just principal and interest, we're keeping it simple. Over the course, it's going to be 30 years, 12 months in a year, it's 360 months. In total, your payments will be $910,000, $910,134. In interest, you'll pay $530,134. And this is the key. Well, the method we're going to show you, I'm going to show you here in a moment, is essentially helping with the interest, because that's how you save money. No matter what, you got to pay back that. So it's the interest that we're manipulating. All right. Now, what's the real total? In other words, when you're all done paying for the house, how did I get the real total of $950,134? Well, your payments added up to $910,134. You put $40,000 down. Okay, so the total that you paid was $910,134 plus $40,000. Okay, you add 40 and 910, you get $950,134. Okay, standard mortgage. Again, house 420, put 40 down, 380. Okay, what's the other option? Now, listen carefully. Very important. 420,000, same house, right? You got $40,000. You only put 20,000 down. You end up with a mortgage of 400,000, which is more than this. Evidenced by the fact that the payment is more. $26.61 as opposed to $25.28. Why? Well, because the mortgage is more. Okay. Now, you walk out. In this case, you walked out with your mortgage after closing of $380,000. In this case, you walk out with a mortgage of $400,000. And you still have 20, because remember, you've got 40 to put down, but you didn't put 20 down. You put 40 down here, you only put 20 down here. This represents how much you put down, this row. Within a day or 2, or even down the road, but let's just say right away, first thing you do, you made a $20,000 payment after a couple days, and now you owe $380,000. Technically, your mortgage is $400,000, just like technically this mortgage is $380,000. But when you made this $20,000 payment right away, it immediately went to principal. It's a principal payment. So now you only owe on the loan $380,000. How much are you going to pay in total after 360 months? You're going to pay $819,454. In interest, it comes out to $439,454. Total, just like we did the other one, How do we get the total? We say, okay, what are we going to pay after 360 months? $819. And then we're going to add the 20 that we put down and the 20 that we made as a payment, which is a total of 40. So the total, 819 plus 40, is 859. Here you go. This is it. In this example, you paid a total at the end of $950. Here you paid a total of essentially $860. All right, so you saved $90,000. The difference between this method and this method. And you saved $90,000 in interest. You saved 90 grand. How is that possible? It makes no sense. You bought a $420,000 house in each example. You basically applied $40,000 to this one and $40,000 to this one. But you applied it in an interesting manner. Here you said, I'm taking it to closing. Here's my 40 grand. The bank says, great, here's your mortgage of $380. In this case, you only took 20 to closing and you hid the other 20 behind your back. You walked out with a $400,000 mortgage. And then, a couple days later, you threw $20,000 and knocked the principal down. So the interest is being calculated very differently. And it comes out that you saved $90,000. Now, thank you for watching. I hope this has been helpful. Throw it into a mortgage calculator. If you think I'm wrong, you think I'm right, please leave comments below. Smash that like button so more people can learn. Please do subscribe because I have all kinds of tips and tricks and hacks to get out of debt, how to use credit cards properly. But next, I'm going to have a video, so please do subscribe, on this exact method, but applying velocity banking to save not 90, but 180,000 and more, depending upon how many times you implement the method. Thanks for watching, and I hope this has helped you.